The Westpac Melbourne Institute Index of Consumer Sentiment lifted by 5% in January, up to 84.3. That's the sharpest jump we've seen since April 2021. And if we look back over the last 2 months, it's now up by 8.1% for what we think is the low point of 78 back in November. However, the index still remains in deeply pessimistic territory. And if you want to look at the last time at which the index was consistently below these levels, you have to go back to that deep recession of the early 1990s. In fact, since the mid-1970s, even that January read is still in the bottom 10% of reads for the index over that long period. So why do we think the index has been lifted in this month? Well, I think the main reason has been interest rates. Consumers have been conditioned to interest rates rising every month. They started to rise in May, so that's 8 months in a row that we saw interest rate increases. But in January, there was no interest rate increase. Now, of course, we know the reason is that the Reserve Bank Board took a break. They always take January off. And I don't think that we're going to see any respite in February. I think that in February, we'll see a resumption of those 25 basis point increases. Some more evidence around the importance of interest rates here was that the confidence of those respondents with a mortgage jumped by 10.7%. And when we asked consumers the outlook for interest rates, 48% of them said they thought that rates would go up by more than 1% or more over the next 12 months. That's down from 60% back in November. That 48% is likely to keep falling, however, because Westpac believes that the outlook for the Reserve Bank cash rate is for a total increase of only 0.75. And there are many, many analysts who think that the rate increases will be even less than that. So that's one of the reasons why I think we've probably hit the low point in the sentiment index. But 2023 is likely to be a year when the index gradually improves, but still remains at what I would call below par levels. You may say, well, we've seen very strong consumer spending in 2022, and yet we've had these record low interest rate, these very, very low confidence levels. So why is that? And of course, the reason I think is the legacies from the pandemic, the accumulated household savings, the reopening effect, and of course, the very, very tight labour markets. But as we go through 2023, so those legacies will start to fade. And I think that consumer spending will slow to be more in line with this below par consumer sentiment. One of the most interesting aspects of the results today was the lift in expectations. So one of the subcomponents, the outlook for the economy over the next 12 months, was up by 10.3%. Another subcomponent, the outlook for household financial conditions, was up by 6.6%. So there was quite a degree of optimism in the outlook, and I believe related to this interest rate pause. We also saw a substantial improvement in confidence around the labour market. The labour market index improved by 8.4%. It had weakened over the last couple of months, but we've now seen a return to very strong levels of confidence in the index, indicating that that tight labour market, that confidence in jobs, is still very much sustained. On the other hand, we saw weakness in the outlook for purchasing conditions for houses. That index fell by 4.4%. But basically that index has been stuck in that 75 to 80 range since March last year. And at that time it had fallen by over 40% relative to the peak in November 2020. So basically what we're seeing in terms of confidence around buying conditions is that they remain very poor, but they haven't deteriorated much over the last 12 months or so. We also have an index called the Westpac Melbourne Institute Index for House Price Expectations. That index is showing some interesting results. It is showing that relative to the low points we saw in that index in August, September, October, November, the index is 7.7% above that average at around 104. Now, at 104, that's above 100, and that's suggesting that a majority of respondents are expecting that house prices will actually rise over the next 12 months. So the interest rate effect is certainly supporting some confidence in the outlook for housing. Well, the Reserve Bank Board meets on February the 7th to decide the next interest rate move, and we confidently expect that we'll see a return to those 25 basis point increases. I think what we've seen over the break has been some very, very strong data for retail sales. Retail sales in the month of November are up a stunning 1.4%. We've seen a rise in inflation from 6.9% to 7.3%. And of course, we continue to see very tight labour markets. All of those factors, I think, will conspire to ensure that the Reserve Bank will raise rates in February. And I don't think that they'll be giving any relief in terms of indicating that it's likely that that will be the last move. I think they'll very much leave their options open to move in March, and indeed indicate that they still retain that tightening bias. Thank you.